of a company, Medi Assist, that joins in after their fourth quarter numbers. Satish Gidugu, who's the Chief Executive Officer, joins in. Satish, thanks a lot for joining in. The first obvious question, right? What's the growth prospect that you have for the next year, given the business that you're in, given the environment that you're in right now as well? There's a fair amount of global uncertainty, perhaps for some of your clients as well. So in light of all of this, what's the target that you've set yourself for?
Good afternoon, Mangalam. Always a pleasure to be here. Thank you for having me here. So I think we continue to grow in all the key segments that we operate in, right? Group, we've grown faster than the market from a premium perspective, and so as in retail. And we've also done well in the government and the international segment. So all in all, given the growth situation in the Indian insurance industry, we're happy that we've done better than the industry in on all aspects. So we've just received the regulatory approval for concluding the acquisition of Paramount TPA, which should approximately add from their last year's reported numbers about a 20% further growth on a pro forma basis. And of course, the real value is subject to the timing of the acquisition. And we continue to hold to what we've always said, that we will grow at par or faster than the insurance market growth rates in India. And that continues to be our focus.
Okay. Satish, hi, welcome to the show. Well, I was just looking at your EBITDA margins, 21.6% as per your presentation. And you have indicated that, the dilution from all of the acquisitions is in fact fully absorbed by the company. So give us a sense in terms of what this trajectory could be, considering that this is probably a multi-quarter high. I mean, just by a few basis points, but nonetheless, it's one of the highest margins that you've reported.
Thank you, Ekta. Historically, prior to the 3-4 acquisitions that we concluded in the last 2 years, we were traditionally at 23-24% margin. That was our steady state margin. And our efforts continue to sort of get back to the steady state margin, of course, in a much larger and a consolidated book. Clearly, we're on track. And of course, there's, that will be adjusted in the short term by any impact coming in from the Paramount acquisition. But otherwise, that's the focus.
Right. I'll have to ask you this question. Health insurance have been seeing higher underwriting losses. Does that mean that you're going to increase rates for some of the group insurances? That's point number one. And secondly, on the margins itself, how do you see margins for both your retail and group business shaping up going forward, given the sort of higher underwriting losses that you're seeing?
Fortunately, we're not in the business of pricing insurance or underwriting. So, however, if you look at the group business, while the headcounts may not necessarily have gone up as much, there's a significant expansion in benefits. So the premium growth is not just from an inflation or a price correction perspective. There's a significant number of new benefits that are actually coming into the group benefits today. And the covers are widening and expanding. So there's a fair bit of healthy growth from that perspective. So we're not very impacted by the underlying growth in the unit rates of insurance, because we are very focused on the service provisioning side of it. And from a margins perspective, one of the reasons why we don't split our group and retail revenues is we've been able to, using technology and our scale, get to almost a homogeneous backend that actually runs in just the same way for group and retail businesses. So to that extent, that's how we're able to build economies of scale.
So what is your guidance on both group premium under management as well as retail?
Our guidance is whatever is the industry growth rate, we will grow at par or faster than that. And we've done that for the last 4 or 5 years on both group and retail. In fact, retail, our own retail has grown at about a 29% compared to a very low in the market. Group also, we've grown at over 14%, and that will further get strengthened with Paramount coming in. And because Paramount is the second largest portfolio in the group book in the country.
So you're exceeding 12% and 29% respectively in FY26.
Hoping that the industry will in fact grow even faster, and then the growth will come back to the industry itself.
Curious to know the kind of cost savings that are likely going forward as well, because I'm looking at some of the data that you've put out. 41% of your inbound queries now managed by your self-service channels, which is the IVR chatbot and WhatsApp, which does not entail a lot of costs, and also through your fraud detection engine, AI ML based, technology that you've done, there's nearly 400 crore worth savings for insurers as well. So from your own, tech stack at the back end, what's the kind of further margin improvement that we can see here?
I'll split that answer into two parts. One, like I said, our steady state margin, we believe, is between like 23-24%. So that's what, we aim to sort of, get back to, subject to any temporary adjustments to acquire Paramount and, integrate. But from a very interesting point that you brought up there, Mangalam, I think the investments that we've made in fraud detection, etc., the savings actually go back to the insurance companies, right? As a service provider, today we do not have the equivalent of a gain share on some of the savings that we deliver. But having said that, this is our North Star metric that we improve policyholder experience, but at the same time improve the profitability of the insurers by weeding out fraud, waste, and abuse. And that's actually one of the reasons why we are now sort of decoupling or unbundling some of these capabilities, like the fraud detection AI models or the customer support AI models, and allowing insurers who don't traditionally work with the TPA model to also benefit from some of the capabilities we have built. Today, if you look at technology-led revenues outside the TPA business are probably about 1.5 to 2% at the consolidated level. And we seeing fair bit of interest from the insurance companies to actually leverage just the technology components too, and not just the fully baked in TPA services.
Right. So could that provide a funnel to the insurance companies for client acquisition as well? I'm just trying to understand, because you are trying to improve the experience for your users while improving the profitability of your insurers. So could then at some point you look at it as a front end, say a marketplace for insurance? Could that be on the horizon? Is there a possibility here?
No.
Or you monetize all the services that you are offering?
We will not distribute or sell insurance because, as our wholly owned subsidiary is a licensed TPA, so broking or distribution of insurance is out of the question from an insurance perspective. But our belief today is that, one of the things that we've done, right, the things that people routinely talk about is the cashless and the discharge experience and why it takes time with insurance. Today, in the last year, about 100,000 patients walked out of the hospitals even before the bills got generated, because our AI technology was able to predict their out-of-pocket just on the day of admission itself. And they were able to just pay that amount and walk out of the hospital the moment the doctor said you're fine to go home. So for our policyholder experience improvement and our insurance companies' profitability improvement are largely predicated on how much of the insurance business in the whole country we're able to impact directly or indirectly. Today, we have about a 20% market share, and I think there's a fair bit of headroom for us to deliver this impact to the rest of the cohorts.
I will concur with what you say here, because I have had a personal experience here too with, the Medi Assist. What happened was we'd gone to the hospital for our daughter's birth, and before we were discharged, part of the insurance claim was done by Medi Assist.
Okay, well, that's wonderful. But Satish,
thank you so much for saying that live, but appreciate that. Thank you.
Satish, before we wrap up this conversation, I just wanted your view considering what is taking place with United Health in the US. It's one of the largest insurers in the world, and the kind of fraud that they're being investigated for now. Any learnings and thoughts considering that you're from the same space?
It's a tough business that we run, right? And it's also very emotionally charged moments where people actually experience insurance. And there are 2 or 3 fundamental issues that we have as a country. One, we don't understand how to buy the right kind of insurance, right? We think like 4 lakhs or 5 lakhs of sum insured is a lot of money. And then obviously that sort of fails to protect in the moment of truth. And secondly, you have to also choose the right kind of a product, right? From a membership perspective, because you could have a 5 lakh sum insured, but maybe there is just a capping of 50,000 rupees for a particular procedure. So I think what we would like to see is all of the work that we are doing in terms of understanding, digitizing data and creating patterns that eventually we're able to help insurers and the membership right size their products, understand, what is the right kind of cover. And of course, hopefully that what we're doing as Raksha Prime and allowing people to walk out of the hospitals without waiting even for a minute, really driving people to adopt cashless 100% of the time so that the experience also improves. Lastly, I think fraud, waste and abuse is a general problem in across the globe. while I can't put numbers, I mean, you've seen the work that we've done with AI, about 400 crores of savings last year just for the portfolio that we manage. And I think a lot more work can be done in a concerted fashion by the whole industry. And our objective is to take this to the entire industry.
All right, Satish, thank you so much for joining in. Wish you good luck for the remainder of this year as well. The growth that you're targeting above and beyond the industry with steady state margins between 23 to 24%, net improving the experience for everyone. Take a short break, come back on the other side. We'll talk about the pharmaceutical space. The management of JB Pharma joins in to talk about their fourth quarter numbers.